Since hitting a 14-month low near 3.95% back in mid-October, U.S. 10-year Treasury yields have been climbing at a slow and steady pace. As of January 13th, yields are just under 4.2%. Now, there appears to be two main forces behind the move higher. First, investors are increasingly pricing in the possibility that the current economic expansion accelerates into 2026. Tax cuts and deregulation could support that growth, and in that environment, the safety of Treasuries becomes a bit less appealing. The second driver is more concerning. There's a growing belief that elevated government spending and large deficits could persist into 2026, and that would mean more bonds issued to fund spending and service debt, adding supply to the market and putting upward pressure on yields. Now, inflation also remains part of the conversation. Even modestly above trend inflation eats into the real return of long-dated bonds, which can make them less attractive to investors. On January 13th, the latest CPI report came out as expected at 2.7% year over year. However, month-over-month increase was a softer than expected 0.2%. That leaves bondholders weighing a key question. Is inflation cooling enough to bring relief, or is it still uncomfortably above the Fed's 2% target? Now, there is one final factor to consider. A growing belief that the Fed remains dovish and could become even more so in 2026. That could point to a central bank willing to support the 10-year Treasury if yields rise beyond a certain level, whatever that level is that they view as beneficial to the economy. Potentially, that could limit how far yields can move higher. Now, if a trader believes that 10-year yields will rise from here, they could express that by buying the January 10-year yield contract at 4.19 and targeting a move to the August highs of 4.35. Now, a stop for this trade could be placed below at 4.08. This trade can make $160 if the target is reached and risks $110 if you're stopped out of your level. Now, if a trader believes that yields could fall from here, they could sell the January 10-year yield contract at 4.19 and target a move back to the October lows of 3.95. Now, a stop for this trade can be placed above at 4.29. This trade can make $240 if the target is reached and risks $100 if you're stopped out of your level.